All right, I want to reiterate that retirement is full of surprises, and even the best planning will divert from reality at some point. The thing is, the future, one particular piece that people don't think about and that is an unknown is inflation. Inflation. People tend to view their future costs in current dollars. They don't always anticipate how those particular costs they grow with inflation. Stop and think back about 30 years ago. What was the cost of a gallon of milk or a gallon of gas or a simple visit to the emergency room? Now think about those costs today and what they'll grow to over the next 30 years when you're not working. That's inflation. Or how about your longevity? Many people end up living far longer than they expected, and that requires more money at a time when it's difficult to work. Look at it. Who wants to work at 80 years old? Who wants to work at age 90? The thing is, no one knows how long they're going to live, and even while they're living, how they're going to feel. Many people also underestimate how much money they need to maintain in pre-retirement. And who wants to see their standard of living drop while they're in their retirement? And then there is one huge factor, and that is healthcare costs. That's the 10,000-pound gorilla in the room. That includes your out-of-pocket payments for services and drugs, plus Medicare and insurance costs, which continue to rise. Now, at this point, you may be thinking, okay, so what's the first thing I need to understand about retirement and taxes? Well, get ready, ladies and gentlemen. Here it is, our first key. You have to know what your after-tax retirement saving picture looks like before you actually retire. I'm going to repeat that. You have to know what your after-tax retirement savings picture looks like before you actually retire. Reason why is because a $500,000 401k or IRA balance isn't really $500,000. You have a partner, and that partner is the government. The government has a claim on part of your money because the taxes were deferred in those vehicles. When you put that money in, you were accumulating. And as I forestated, you have a new partner, which is the federal government. And the government will get their share. When you're forced to start your RMDs after you turn age 72. Obviously, the higher your tax rate in retirement, the less your account is actually worth. Let me say that one more time. The higher your tax rate in retirement, the less your account is actually worth. If what you thought to be true about your retirement dollars and taxes turned out not to be true, the question is, when would you want to know about it? Now I want you to note that RMDs, or required minimum distribution, were suspended for 2020 as part of the Coronavirus Act, which is the Coronavirus Aid, Relief, and Economic Stimulus Act, the CARES Act. So if you're turning 72 this year, you won't have to worry about your first distribution. But we all hope that things will get back to some sense of normalcy this year, 2021, and your required withdrawals will begin on next year. All right, here's an example I'm going to throw out there. Let's just say you could expect to receive $500,000 from your IRA, earning about 6% per year at various tax rates. And let's throw this in there. In that, the lower tax rate is the more that you're going to keep. So that's pretty simple in theory. It's difficult in practice, but difficult, simple in theory, but difficult in practice. And by the way, of course, this presentation applies to both pre-retirees and retirees. So don't worry if you've already started your retirement. Tax planning is important throughout your entire retirement. All right. That illustration that I just provided for you is just a hypothetical and assumes a 6% rate of return. This does not represent the performance of any investment product, and your results may vary. Again, ordinary income tax rates will apply to withdrawals from a tax-deferred investment. An investor should consider his or her current and anticipated investment horizon and income tax bracket when making investment decisions. That was my disclosure. All right, you might be thinking, okay, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay my health care costs. But one thing you need to understand when creating your retirement tax strategy, and that is Social Security and Medicare have their own tax traps that you need to plan for as well. People don't think about that, but you need to plan for Social Security and Medicare tax. Now, let's go back to our initial example with the tax brain teaser in the beginning. Let's go back to Bill. We want to understand why he paid such a high tax rate on that extra $1,000 that he took out of his IRA to go to that concert. Remember, Bill has $38,000 of IRA income, which is a part of his AGI, or adjusted gross income, of $56,525. And he has $25,000 of Social Security benefits. That puts him squarely in the 22% tax bracket, and he takes the standard deduction. Yet, when he took that extra $1,000 out of his IRA, he got hit with a nearly 41% marginal tax rate. That's $407 on that $1,000. Almost 50% on that $1,000. Let's break down how this actually happened. First, let's remember the only difference between our two scenarios here is that Bill has taken an additional $1,000 from his IRA, which we talked about early on. After the concert trip, after his concert trip going to see Willie Nelson, he has $39,000 in IRA income. So we see here that by adding that additional $1,000 of actual income from the IRA, it increased his AGI, or his adjusted gross income, and his taxable income by $1,850. That means for every dollar of income Bill actually received, he's being taxed on $1.85. How did that happen? Here's the deal. Depending on how much other income you have, the amount of your Social Security benefits that are taxable will vary. For instance, if your other income is low enough, all of your Social Security benefits will be income tax free at the federal level. On the other hand, if your income is high enough, up to about 85% of all of your Social Security benefits can be taxable at whatever your personal rate is. So Bill finds himself in the latter scenario. At his current income after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he must also add an additional 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at his 22% tax rate for every $1 of additional IRA income that he actually receives. If you do the math on that, it comes out to 40.7% real tax rate on the additional $1,000 of income. That's the so-called Social Security tax torpedo. I'll repeat that phrase. It's called the Social Security tax torpedo. It can impact single filers and married couples with even the most fairly modest income during any stage of retirement. It's one reason that planning for taxes in retirement is important.